Over the last few decades, a quiet yet significant phenomenon has been unfolding. Every new generation is finding it increasingly challenging to attain the same level of financial stability and success as its predecessor. Gone are the days when parents could expect their offspring to surpass their achievements. Today's millennials and Gen Z face disheartening statistics that suggest they are likely to fare worse than their predecessors. This trend is not limited to a few individuals, but is changing the shape of entire economies. A society flourishes when elderly individuals plant trees that they know they will never benefit from. A wise Greek proverb from ancient times. This sentiment holds true today, despite the challenges faced in our modern economies and the study of economics itself. However, do we truly live by this idea? For the first time since the Industrial Revolution, successive generations are not experiencing the same level of prosperity as their parents. While there have been occasional setbacks and historical anomalies, this trend holds true for the overall populations of most developed economies. It used to be an expectation that each generation would enjoy a better lifestyle than the previous one. But today, that is no longer the case. In fact, most young professionals can only dream of achieving the same lifestyles their parents had. Younger generations are finding it increasingly difficult to secure reliable jobs, afford comfortable homes, start families, and save for retirement. This is concerning, considering that the world is now wealthier than ever before, surpassing even the prosperity witnessed during the baby boomer era. So, why is this happening? How is it that a wealthier world is producing poorer generations? Is there a fundamental cause behind this trend? And if so, can it be reversed? If not, does it mean that each subsequent generation will be poorer than the one before it? It is worth exploring whether this issue truly matters, considering that everyone will eventually pass away and pass down their wealth anyway. However, it is also important to consider the implications of such a trend on societal well-being. Furthermore, let's delve into another intriguing question. Is it better to be born into a large cohort with many peers of the same age, or into a small cohort with fewer individuals of the same age? Traditional economic theory suggests that a small cohort is preferable, as it reduces competition for jobs, housing, social programs, and even basic natural resources. But then, how do we explain the baby boomers? Despite being part of the largest population explosion in history, they collectively possess significant wealth. Numerous studies have shown that millennials, born between 1981 and 1996, have less wealth and income than baby boomers did at the same age. Baby boomers held a 21% share of the total US wealth in 1989, while millennials currently hold only 3%. The average millennial has a net worth of about $8,000, barely enough to cover an average new car loan. Factors such as student debt, higher housing costs, and stagnant wages are preventing millennials from accumulating wealth. The younger generation, specifically Gen Zers born after 1996, are facing a bleak future when it comes to their financial prospects. The current job market is the worst it has been since the Great Depression, with unemployment rates soaring to over 13%. Starting salaries are lower than they were 20 years ago, while student debts are higher. These factors hit harder during the pandemic, but the underlying issues have been present for years. Lord David Willetts, a British politician, demographer, and author, proposes a thought-provoking hypothesis. He suggests that, in a democratic system, belonging to a larger cohort may actually be advantageous. A larger cohort grants more voting power on generational issues and greater influence in marketplaces. When the baby boomers were young, their voting patterns aligned with policies that benefited them, such as affordable or free higher education, family support systems, and robust social welfare. As they reached the peak of their careers, their priorities shifted, and they favored lower income taxes, reduced business regulations, domestic industry protection, and even zoning laws that safeguarded the value of their homes. The push for suburban living with single-family building requirements led to larger and more desirable houses, as only a limited number of families could reside in those areas. In the 1950s, houses were simply commodities, with most of the expense invested in the structure itself. It was not uncommon for family cars to cost more than the family home. Fast forward 50 years, and these houses have transformed into investments, serving as financial assets alongside being places of residence during old age. The baby boomers now vote in support of retirement benefits, pension schemes, medical infrastructure, and the removal of wealth taxes, even if it means compromising the very schemes that once served them well in their youth. The reasons behind the younger generation's financial struggles are multi-layered. One of the significant factors is the rising cost of living and major purchases. The cost of buying a home, for example, has increased dramatically since the 1970s. Baby boomers could buy a house for $23,000 in their 20s, which was around 2.6 times the average salary. In contrast, today's first home costs $199,000 on average, which is over 4 times higher than the average salary for 25-34-year-olds. Education is another significant expense that has increased over the years. Baby boomers paid less than half for college tuition than what students pay today. The second factor is globalization and automation, which have eliminated many well-paid entry-level jobs that offered financial stability in the past. Manufacturing and clerical roles have been declining since the 70s. And now artificial intelligence threatens many middle-level office jobs too. The job market is now divided into high-skill, high-paying roles and low-skill service jobs with fewer steps in between. This polarization makes it difficult for graduates to find jobs that offer long-term financial security. Lastly, wages across the economy have stagnated over the years. The average hourly earnings peaked in 1973 and have remained stagnant since then. This stagnation makes it harder for young people to save and build assets, which further contributes to their financial struggles. In recent years, a significant shift has occurred in retirement planning, with the responsibility for funding retirement shifting from employers to individuals. This change has increased the risk that individuals face, particularly younger generations who lack the security of employer pensions that baby boomers enjoyed. This shift has contributed to a generational wealth gap, which is already having a profound impact on our economies. For younger generations, the wealth gap has resulted in reduced access to credit due to falling assets. This has made it more difficult for first home buyers to enter the housing market, with only 33% of the US housing market comprising first home buyers, the lowest figure in history. Additionally, consumer spending growth has been slower compared to previous generations, as younger people are more price-sensitive and less likely to spend on luxury goods and services. The wealth gap has also led to a delay in important life milestones such as marriage and having children. This delay, coupled with lower birth rates, has resulted in a shrinking workforce of the future. Japan's aging population and shrinking workforce serve as a warning of the consequences that may befall other countries in the future. Furthermore, the later start that millennials have made on adult life milestones has reduced consumption in industries such as automobiles, furniture, and appliances, which rely on these events. This has also affected fees from services such as real estate agencies. The effect of generational poverty is self-perpetuating, as children born into low-income households are less likely to escape poverty as adults. The younger generations are more diverse, with Hispanic and Black millennials having fewer assets, further dragging down the averages. Reversing the wealth gap may prove challenging, as globalization cannot easily be undone, and populations are aging, putting more strain on millennial and Gen Z workers to fund healthcare and pensions for retirees. However, governments can take steps to address the wealth gap, such as providing access to education and job training programs to boost skills, changes to tax and housing policies to help young people buy homes, raising wages, expanding the social safety net, and rethinking pensions from defined benefit to defined contribution plans. The wealth gap is a relatively new trend historically, and its impact is concerning. It is already having a negative effect on growth. However, by understanding the causes, we can make policy changes that create more opportunities for future generations. While the wealth gap cannot be fixed overnight, patient reforms can help stop it from compounding. The search results reveal why younger generations are struggling financially and how it affects the economy. The reasons for their financial struggles include having lots of debt from student loans, getting paid less money for their work, not enough investment in new ideas and technology, unfair trade deals, and a middle class that's getting smaller. This financial struggle is causing the US to lose its place as the top economy, as other countries like China grow stronger. Some people think this is because of unfair trade practices that benefit other countries more than the US. To fix this problem, some experts suggest giving tax breaks to companies that create jobs here in the US instead of outsourcing jobs overseas. They also recommend training people for jobs in manufacturing, making sure that companies that import goods from other countries that don't protect the environment pay extra taxes, and limiting connections between the US and China when it comes to important technology. Other ways to help include giving more help to people who are struggling financially, investing in new ideas and technology, making sure that trade deals are fair, and helping the middle class grow.